So let's get started. As you were likely aware, the market is drawn to a lot of liquidity, which results in constant volatility and continuous oscillations. It's a common scenario where traders miss out on excellent trading opportunities solely due to market behavior. For example, the market can become highly volatile when the price approaches their desired entry point, often failing to provide a suitable entry opportunity for them. Alternatively, traders may miss a trade because they are away from their screens when the price reaches their intended entry point. Interestingly, the price mitigates the recognized supply or demand zone, and then proceed in the direction they had anticipated. This raises an important question: what should we do when faced with situations like these? The solution is straightforward: we must utilize the smart money concept's continuation entry strategy to enter the market and execute trades. Now let's delve into the details of SMC's continuation trading strategy and explore the essential criteria and rules of the entry model that we need to consider before executing a trade with a high probability of success. If you miss the change of character or flip pattern, or if the price action doesn't provide an opportunity to enter the market, then taking the continuation trade becomes the easiest and safest way to execute trades. Imagine we have a bullish structure on the 15-minute time frame in which we are conducting our market analysis. That price has created a series of break of structures to the upside, and if we look at the most recent break of structure, we see that price formed a perfect unmitigated demand zone just located at the extreme, with inefficiency placed above. Next, what we do is zoom in on a lower time frame, for example, the 1-minute time frame. We wait for the price to touch the unmitigated demand zone from the higher time frame, experience the reversal, and then form a change of character or flip pattern indicating a shift in market structure. As seen here, the price has created a change of character pattern and created a new demand zone in the 1-minute time frame, attributed to the bullish wave of the change of character. With the emergence of the change of character pattern, we understand that it signals a loss of control by sellers, and we can anticipate a bullish order flow to the upside. Therefore, we should explore potential opportunities to enter the market by opening long positions. Now let's say you somehow missed this entry opportunity during the change of character, or you simply want to open additional long positions. Price after the mitigation of the demand zone, it reversed and shifted its character to the upside by breaking and closing above these structures, and breaking through several supply zones. If you couldn't execute any long positions from the change of character supply zone, in such a scenario, the recommended approach is to use SMC's continuation strategy to enter the market. To achieve this, the price needs to break the recent structure to the upside, and pass through this 1-minute supply zone, creating a newly generated supply zone. In this case, I wouldn't recommend placing any limit order at this newly generated demand zone due to potential risk. There's still a high probability that the price could use this demand zone as an inducement to generate more liquidity. Therefore, it's advisable to wait for the price to form liquidity zones and sweep them before tapping into our newly recognized demand zone. What we're looking for here is a pullback after breaking the recent structure and forming a liquidity zone, such as double bottoms, triple bottoms, or trend line liquidity above the new demand zone. It doesn't matter whether the price pushes to the upside and creates a new break of structure, or remains choppy for a while after the creation of the liquidity zones above the demand zone. We can now set a limit order in the demand zone. This is because we have a very strong confirmation factor if the price sweeps the liquidity zones that is formed above the demand zone before tapping into it. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. Market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. To execute a trade based on the SMC continuation entry model, there are 4 essential criteria to consider. The first rule requires the price to form a change of character pattern or flip pattern after reaching the higher timeframe supply or demand zone. Subsequently, we must patiently await a break of structure and a zone breakout in the price movement. The third rule emphasizes that the price should have left inefficiency behind when forming a break of structure. The last and most crucial rule is the presence of static liquidity zones near our identified point of interest. In summary, to have an opportunity to execute continuation trades, it's essential that all of these rules and criteria are met and there are no exceptions. Here, all the mentioned criteria are met. Next, we place our buy limit order at the highest point of the demand zone with a stop loss a few pips below the lowest point of the area. For the take profit, the target is the swing high at the extreme. The continuation entry model allows us to execute multiple trades simultaneously in the market's dominant direction. For example, each time a point of interest is created that meets all the previously mentioned criteria, this strategy can be employed for trade execution. However, it's vital to consider some key points to prevent significant losses and ensure high probability trades, which we will elaborate on in detail on the next topic. In the following, we can see that the price has once again created a new break of structure, and it's already broken through the next supply zone, leaving inefficiency behind. Thus, we have another unmitigated demand zone in the 1-minute time frame. Additionally, we can see that the price formed a bullish trend line liquidity above our newly identified demand zone. Retail traders who rely on trend lines and chart patterns enter the market every time the price touches the trend line, placing their stop losses just below it. This approach results in the formation of a substantial liquidity pool position just below the trend line, waiting to be cleared by the market. Consequently, numerous stop losses are closely aligned with the trend line and are positioned by retail traders. In this scenario, it's highly likely that the price will push back down to clear the liquidity below the trend line, triggering the stop losses of retail traders. It aims to fill the inefficiency left behind, and then tap into the demand zone situated at the extreme. With all the criteria of the continuation entry model met, we can now place our buy limit order at the highest point of the order block, and set the swing high as the take profit target. To execute multiple trades simultaneously, there are certain points and rules you must consider. Limit the number of open positions to a maximum of 3 at the same time. Always remember that the position size you risk for the first entry should be halved for the next upcoming trades. For example, if your first position size is 2 lots, it's advisable to risk half that amount, which is 1 lot for the subsequent trades. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. See you in the next episode.